It took this long to dawn on me. I understand why they're calling this company Target, right? I understand it now. Let's take a look at these absolute smasher of an earnings report they just posted today. Target's up 12.5% because of it. Holy crap, we got a lot to talk about. Very nice stuff. Obviously, off the back of what Walmart posted, which was a smasher of a quarter yesterday, they went ahead and Target, they say, give us a shot too, baby. Give us a shot. Non-GAAP EPS of $3.38 beats by $1.74. GAAP EPS of $3.35 beats by $1.81. Massive, massive profit beat. I mean, what can I say? What can I say? The profit beat is freaking credible. It's good to see that, obviously, because there's a lot of companies, really, that are missing big time in terms of EPS. So it's good to see actual growth in EPS from a company. I mean, especially a retailer in which safety precautions are at the forefront of everything, and increased wages, everything like that. I mean, they've increased associate pay, and they're still posting profitability to a good extent. Good to see that. Revenue of $22.98 billion is up 25% year over year. Holy crap, 25% growth for a company like Target is crazy. A physical, a brick and mortar retailer growing 25% seems wild. Beats by $2.87 billion. Massive beat on on revenue as well. So top and bottom lines looking massive. Comp sales of 24.3% versus a consensus of 7.6%. Holy crap. That is absolutely incredible. Those numbers are really good. So as far as some of the finer details too. Transactions were actually up 4.6% from a year ago. So we saw Walmart in which the transactions declined 14%. Target actually saw transactions rise during this, which is crazy to think about that. But a majority of it does come from digital. So average ticket price went up 18.8. We saw Walmart raised similar to that. But digital sales for this company were up 195% year over year during this quarter. 195%. Triple. Not double. Triple. Walmart grew 100%. Target, they know what they're doing in online retail, baby. Up 3 times the amount year over year. Target says it saw unusually strong market share gains across all 5 of its core merchandising categories, as we saw with Walmart as well. Operating margin was 10% versus a 5.7% consensus. Strong expense leverage on robust top-line performance was cited. Retailer churned at EBITDA of $2.92 billion, up 77% year over year that they increased that EBITDA. That's money brought home, baby. No, they did give no guidance either, and guess what? They gave no guidance, and the stock skyrocketed. Walmart posted a very good earnings, but cited that there may be slowdown, and they fell. Target isn't going to say anything about slowdown, so that's why the stock is up. So, so Target didn't give investors any reason to think that Q2 momentum isn't continuing, which is the reason why Walmart stock was down. Execs stated that August comp sales are up at a low double-digit clip, even with the back-to-school off to a slow start. Back to school obviously not big this year. Digital sales during the quarter were spectacular. Target management reminded that stores are performing extremely well too. Just the stores, physical stores, are performing well. New stimulus deal was called very important to keep consumer spending vibrant, as I said. Not sure necessarily if that's going to happen. Analysts are positive, though, on Target. Very nice stuff to see. And as we look, obviously, at Target here, we do want to look here at this second quarter earnings, baby. And we'll try to pick out some of the good stuff and see what we have going. So, obviously, the strongest quarter comp sales growth they've ever seen. The strongest. This is going to be the best year Target's ever posted, which is incredible to think about, right? And there's a lot of reasons for it. So, money spending has kind of been shifted. It's definitely decreased, right? People aren't spending necessarily as much, but it's shifted to where it's focused on a few certain areas, right? There's only so many places to buy right now. And guess what? A company like Target, retail is gaining all of those sales. People want to spend money just by nature. They love spending money. And retail's getting those sales. We saw it from Amazon. We see it from Walmart. We see it from Target. Retail's gaining the money. So store comp sales increased 10.9. Digital sales grew 195%. Wow. Whew. Accounting for 13.4% of Target's comp sales growth. Stores fulfillment or fulfilled more than 90% of Target's second quarter sales. That is nice. Stores are rocking it. And same-day services such as grocery pickup, drive-up, and shipped grew 273% and accounted for 6 percentage points of the total company comp sales growth. That is crazy. And same-day services are going to continue to grow. When you think about the future of this company, it's going to be in e-commerce and services like this. No touch, very simple, quick services. That is where this company's future lies. Unusually strong market share gains in all categories. The company has gained $5 billion in market share. Very nice. Second quarter GAAP EPS of 3.35 was an 84% increase year over year in EPS, which is incredible to see that. I don't know. From my perspective, those numbers are just ridiculous to see. And again, Walmart put up a very good quarter, but Target here put up an even better quarter. And some people may be able to make statements as far as, well, Walmart is a company bringing in 5 times the revenue, so it makes it more difficult for them. Really, it's closer to 6 or 7 times the revenue. So it does make it more difficult for them to grow at a quicker rate. It really does, which is a fair comparison. But I do just want to say that this is a company that is rocking it out. Rocking it out. There's no doubt about it. I mean, both companies put up incredible numbers, but they are not going to give guidance, obviously, due to the uncertainty of consumer shopping patterns, because you never know at this point. It's really weird how things are going, and it's really hard to say necessarily what that's going to look like. So, tax rate of 22.8% on this company. The company paid $330 million of dividends compared to $328 million in the second quarter of last year. So 30.1% increase in dividend per share. Nice to see. Offset by a decline in average share count. So less shares out there, which I like to see. And higher dividend. We love seeing that. It's suspended share repurchases, as you know, which I think is fine. There's still a $4.5 billion they can spend on share repurchases, but I'm okay with them not doing it. I'm not a massive fan of share repurchases. If it's at a good price, obviously, I love it. But I'd rather, let me buy those shares, baby. Let me buy them. I want all of them. I'll take them for free, too, if you want to purchase them and give them to me. So we will go ahead and take a look at the balance sheet, as we love to do. We love the balance sheet. And this is a company that's nice to me. They give me, just like Walmart did, a 6-month comparison and a full year comparison. It makes me happy. Total current assets, you'll see they flooded the balance sheet with cash, as really a majority of companies have. Nothing weird about that. $17.6 billion in total current assets compared to $12.1 a year ago and $12.9 6 months ago. Nothing crazy there, but those are pre-pandemic, so not a shocker. Total assets in general of $48 billion, relatively even. Okay, we'll take that. That it compares to 41.5 a year ago and 42.7 6 months ago. Good improvement there, and I'm hoping liabilities does not increase by that much as well. So you don't want to see liabilities increase by this right around 5,500 mark as well. You'd like to see it really grow by less than that, because that means the stockholder equity increases. Now, current liabilities really did not increase much. 15.8 versus 14.3 a year ago and 14.4 6 months ago. Total non-current, though, did see a decent rise. So definitely saw a decent rise. 19.5 versus 15.3 and 16.4 6 months ago. So Overall, though, you do see a growth in this balance sheet, right? Total stockholder investment, or really equity, they call it investment, but of 12.5 billion. That compares to 11.8 a year ago and 11.8 6 months ago. So overall, you see a growth in this balance sheet, and it's looking good. We love to see it, and that balance sheet is beautiful. The balance sheet is mighty beautiful. So again, I like this company, and at these levels, I think people can say we're starting to get to the point where it's a little pricey, and I can understand where you're coming from there. I certainly do. I love this stock under 130 at any point. I even, which people might think is crazy value-wise, I really like the stock even at these levels, just because of the fact that not only are they a fantastic dividend payer, I think there's stock appreciation. There's absolutely share appreciation that's going to happen with this company because of how they are dominating right now in terms of digital sales and just completely dominating in physical retail. We love to see it. But, I mean, good numbers. If you don't have it, I don't think it's a bad thing to purchase, but my cost base is obviously at $70. I don't necessarily buy that much, and if I do, I buy small amounts. I usually just do share dividend repurchases, so that's about it. That's all I got for you today. Hope you enjoyed. We'll talk about NVIDIA next.